Okay, so let's look at the homework assignment, chapter 11. And again, so the way that I prepare these is I do the homework assignment, I print it out and I do the assignment. And so I'm going to, it gives you these in a random order. So unfortunately, the way I printed it out is not the same way it's going to be presented here. So I'm going to have to flip through pages to get to what I'm working on. Okay, so let's start with the first one. What's going to be charged to land rather than cost of building? So many of these, as I'm looking for here, many of these are definitional in nature. So that, okay, there we go. So, when we look at this one, what we're looking for here are things that would be properly considered a land expense rather than a building expense. So let's just start with capitalization of interest. So in the case of capitalization of interest, that could actually be to both land and building, right? Because you'd have to borrow presumably money to buy the land as well as to build the building. So capitalization of interest um, could be to both, in all honesty. Architectural fees. No, those are clearly a building cost. Cost of the foundation, again, clearly a building cost. Demolition of an existing structure. So remember, this is actually um, a land expense because it consists of basically preparing the land for the building of the structure. So in this case, demolition of an existing structure um, is a land expense. Again, I feel like I'm kind of like giving you the answers as I go through these, but you're kind of having to suffer watching this whole thing, and hopefully, again, by me talking about it, the why the answer is the correct answer makes a little bit more sense too. Allocation of cost of copyright. There we go. So how would we allocate that cost of a copyright to future time periods? So depreciation, that by definition would be the reduction in the value of the capital by virtue of the fact that it's wearing out. So it's not depreciation, right? Remember here, for cost of a copyright, the copyright gives you a certain period of time of exclusive use. Um, but to obtain that copyright, you have to spend a significant sum of money to get that protection for the future time period. And so that, by definition, has nothing to do with depreciation. Allocation, again, that's just a well, I guess in this case, it's just repetitive. Allocation of the cost is not allocation. I mean, it is, but that's not actually the term that we're looking for here. Um, Depletion. Um, no, so depletion is like depreciation in the sense that we're talking about a an asset losing its value over time. And then we've got amortization, and that is actually the correct answer. So here, what we're talking about is the fact that the copyright is an intangible asset, and if we want to expense basically the creation of that intangible asset. Remember, the copyright becomes whatever that thing is that is copyrighted becomes an intangible asset once it is copyrighted. And so allocating that cost of making it an intangible asset is amortization. Allocation of cost of equipment to future time periods. Okay. So, we've actually got the same choices here. This is definitional. So let's just think back to what I just all said. Um, the correct answer here is depreciation, because here what we're saying is that as that piece of equipment, that intangible asset, is generating future value, it's being worn out, and that is depreciation by definition. Okay. Expenditures included in the initial balance sheet carrying amount of a long-lived asset. What is that? Um, so in this case here, um, charge-off costs. Well, let me start off by saying this. The correct answer is capitalized costs, the very first choice. Um, Let me talk about the others and why they're not the correct choice, and then we can get returned back to capitalized costs. Um, Charge-off costs, by definition, are the costs where something in our balance sheet had a value and then suddenly it does not have a value, either because we're anticipating being unable to collect from the debtors for that asset, or suddenly the value has disappeared for some reason. Um, so that would be a charge off cost, which has nothing to do with what's being described here. Um, Expensed costs, well, that would be any cost that we list as an expense, such as when we just talked about it, the cost of securing a copyright, for instance. Intangible costs. Um, well, I mean, if we're talking about an intangible asset, the cost of making that intangible asset an intangible asset, I guess, is um, something. But it's not what we're talking about here with the um, expenditures or the expenses that are in the initial balance sheet. Um, that, by definition, is the capitalized cost. Basically, um, what is it that's going to be the thing that is capitalized is going to create future value, and those intangible and those capitalized costs are going to be incurred over time, and so that's our capitalized costs. Okay. Under Under international financial reporting standards, research must be expensed, but some development expenditures may be capitalized. To capitalize development expenditures, firms must demonstrate several factors that include all of the following except. Um, well, by definition, what we're saying here is what is it that would give something, um, by definition, what would give something um, future value? Well, it would need to be technically feasible. So that's not the correct answer, right? Because something wouldn't have future value if it was not technically feasible. Ability to use or sell the asset. Yeah, you need that to give it some value. so that you can actually estimate um, what its value is through the market. How the intangible asset will generate probable future economic benefits. Yeah, that's actually, um, that's just talking about, in some sense, just kind of our definition of intangible assets, right? Like, how is it that it's actually generating the value? That's um, that process, and then the expenses involved, and how it does generate the probable future economic benefits. That would all be part of development expenditures. Length of time the intangible asset is expected to provide benefits. That is not considered. Because you can have an intangible asset that delivers benefits for a short time or a very long time. None of that really matters when we're talking about the capitalization of development expenditures. Um, some assets are short lived, some are longer lived. That's just all part of that process. Okay. Nadir. Okay. Nader Company purchased a milling machine on January 3rd, year one, for $55,000. Machine was depreciated in straight line method with an estimated useful life of 10 years, with end salvage value at $5,000. And that at the beginning of year nine, the company paid $15,000 to overhaul the machine. Um, what should be the depreciation expense recorded for this machine in year nine? And what is the and what is the assets December 31st, year nine book value? Okay, well, let's start to talk about this one. Okay. So year 1, 2, 3, 4, 5, 6, 7, 8, and 9. Oh, that's horrible. Let's do it over here. Year 1, 2, 3, 4, 5, 6, 7, 8, 9. And then let's look at depreciation expenses. The sum of that depreciation, and then the book value. So in year one, that's where we're told it's at 55,000. So that's where we're going to start, 55,000. And we're told we have a straight line method. So I'd mean constant. So to get from 55 55 over a 10-year lifespan, right? That works out to $5,000 a year, because by the ninth year, you would have $5,000 remaining. So what that would mean here is that these are all going to be 5,000. This is our straight line method, all the same cost, depreciation cost. And then we would sum this up here. So this is 5,000, then 5 plus 5 is 10. 10 plus 5 is 15. 15 plus 5 is 20. 20 plus 5 is 25. 25 plus 5 is 30. 30 plus 5 is 35. And 35 plus 5 is 40,000. And then in terms of the book value of the machine, 55 minus 5 is 50. 50 minus, 55 minus 5 is 50. 50 minus 5 is 45. 45 minus 5, 40, and so on and so forth. These are all 1,000. So, in year 9, this would be when we're going to add the $15,000 to overhaul the machine. So that's going to bring up our book value right here to 30 because it was already at 15. So 15 plus 15 is going to get us 30. So the book value is going to become 30,000 in year 9. And that actually answers our two questions here. So what's the December 31st book value? That's going to be 30. What would be the depreciation expense recorded? That's going to be that constant $5,000 expense. Okay. Evaluation of definite-lived intangible assets. Evaluation. There we go. This is definitional. When would we be evaluating an indefinite-lived intangible asset for impairment? Under what conditions would we do that? The biggest thing I can say here is that in some sense it's largely objective, or sorry, subjective. It's largely subjective, up to the auditor or the professional to assess when impairment has occurred. So certainly it could be, you know, when there's a deterioration in the business climate, or when there's a significant um, decrease in the asset's fair value. So those would be situations where, well, in the first case, the deterioration, where that's assessed by a professional that the deterioration has occurred, or if it's actually occurred, where you see that significant decrease in the asset's fair value. So now we're left with no less than every 3 years or annually. And definitionally, we would be conducting this analysis annually as we prepare our various financial reports. So what we're left with is that is not no less than every 3 years. In fact, we would do this work annually. Okay. Ericsson Company. There we go. Ericsson Company holds some crypto on its classified balance sheet. Ericsson, how are they going to report that cryptocurrency? This one is definitional. It is an intangible asset. It meets all the definitions of an intangible asset. Um, and as that value changes over time, that's where we would do the long lived asset impairment. Either again subjectively, where we assess that crypto is either becoming more in favor or out of favor, um, or perhaps we already see that intangible assets value being lost for other reasons. Let's say the blockchain technology ceases to be trusted anymore, or we as a society just treat that kind of asset differently. Um, yeah, cryptocurrency is not a cash or an equivalent. It's not current investment, and it's not a current receivable. Those all have very strictly defined definitions. Intangible assets is about the only one where there is that subjective determination of something having value or not. Okay, Kitty Company. Sounds nice and peaceful. Kitty Company. Okay. Broke ground a new building March 1st. Completed construction November 30th. Made the following expenditures. What is the cumulative weighted average expenditure um, on this project? So remember here, what we have to do is that we've got certain expenditures made throughout the course of the year, and we need to calculate the weighted average expenditure. We're going to need to multiply these expenditures by what portion of the year that we're in. So basically, when are we making that expenditure, um, and how far is that date? April 1st, June 1st, September 1st, November 30th. How far is it away from the completion date of the project, which is November 30th? So, in other words, what we're going to do here, that $450,000 in April, that would be that would leave us with eight months to get all the way to November 30th. So we're going to take this 450,000 multiplied by 8/12, and I get 300,000. Now I'm not checking my work here, so if I make a math error or something, um, you can let me know. But I may be making math errors here, so don't just trust me here. June 1st, so that would be okay. So that's 6/12, 6 months away. 200,000 times 1/2 basically is 100,000. September, that is September, October, November, so 3 over 12, or 1/4. 400,000 times 1/4 is also 100,000. And then this is on the complete. This is actually on the completion date. So it'd be 0 over 12, which is 0. 3, 4, 5. Summing that up. That is $500,000. And so there would be our correct answer there. Okay. Howard Company is going to buy some land. Okay, Howard Company is going to acquire a 5-acre tract of land. On that tract was a warehouse that they were going to use as a distribution center. At the time of the purchase, the land had an assessed valuation of $2,250,000, and the building had an assessed tax value of $7.750 million. Howard paid $16,750,000 for the land and building, and then paid $750,000 to have various modifications made. At what amount? So part A. At what amount should Howard record the land and building? Okay. Okay. So for the land, what we need to do here is consider the fact that the modification was only made to the building, and that the person paid the $16,750,000 for the combined land and building. So what we need to do here for land is we need to divide the future value of the land by the future value of the land and building. And then multiply that by the lump sum purchase price. So in that case, we would have $2,250,000 divided by the future value of the land and building. So that would be the 225 plus this. So that would be oh yeah, 250 000 plus that gets us to 250,000 plus 7,750,000. Multiply that all by the lump sum purchase price, which is the 16,750 million, which in this case I've calculated it as 3,768,750. So that's for the land. Then, if we want to do the building, so then for the building, we would do the future value of the building divided by the future value of the land and the building. And multiply that by the lump sum. In this case, we now have the 7,750,000. Divide that by, same thing, 225,000 plus 7,750,000. Multiply that by the same 16,750, and I get 13,731,250. And so that's how this would be recorded. Why might the managers of Howard prefer to assign a larger portion to the land rather than the building? Well, I mean, I guess the easiest thing to remember here is that land doesn't depreciate, at least for accounting purposes. So there's no depreciation on the land. And so we do, by result, um, as a consequence, we wouldn't we wouldn't want to assign depreciation to the land. It would need to all go to the um, building. The consequence of putting depreciation on land, like maybe you find some way to say, like maybe like a chemical is emitted that's going to like destroy the land, or I don't know, topsoil is going to be worn away, things like that. Well, if you assign some of the depreciation to the land, that's going to alter the way that we calculate the um, depreciation expense. If you gave more depreciation to the land, then you're going to lower what your depreciation expense is going to be in the future on things like the building. And so your net income as a consequence is even going to be a bit higher because your depreciation was higher in the very beginning than it should have been by counting land. Okay. Doggy co. Okay. Now this is probably, in my opinion, I wrote down here, this seemed to be the most difficult one in the assignment. It is pretty tough. Okay, let's look at it. So So I'm not going to reread you the whole question here. But what we're trying to do here is, again, we're talking about something being constructed, and this thing that is being constructed isn't going to be finished until um, October 31st of 2022, or 20x2, I guess. Um, and so if we look at 2120x1, to take that out to 21, sorry, to take that out to um, for 2021, the end point would be the end of 2021. So in this case, um, we would multiply by 11/12. For March, 9/12, right? So now I'm just using kind of the calendar year here, understanding. On 6/1, that would be 7 remaining. On 10/1, that would be, right, October, November, December. And then on 12/31, that'd be 0/12. Um, Now, we are not going to, when we look at things that are happening in 20x2, sorry, I just got to pause here 1 second. Sorry about that. I was being asked a tax question by my wife. And again, I'm not an accountant, so I'm not sure what I'm being asked. Where was I? So if we're looking at the expenses that are being capitalized in 20x1, then we really can't count these because these are occurring in that next year, 20x2. So we're going to need to multiply each of these expenditure amounts by these fractions that give us the remaining portion of the year. Um, and we're going to do that to get our cumulative weighted average of expenditures. So, so we've got, just so we were clear here about what I'm all multiplying and adding, we basically have 5 things that we need to solve for here. Okay. 962,500. Okay, so I just took 1.050 million and multiplied it by 11/12. So now I'm just going to keep going down the line here. 675,000. Again, that's just 900,000 times 9/12. And then 0. And if we add that all up, we get 2,325,000. Okay. Now we need to multiply this by the interest rate. That would be the 6%. And it gets us 139,500. Hopefully that is an option here. It is. Thank God. Always worried about I solve something and it's not an option. If my math all works out, it should be 139,500. Which of the following would be a cost of a building rather than the cost on land? So this is the opposite of what we looked at already. Okay. Demolition of an existing structure. We already talked about that's land. Architectural fees. That is a building expense. So architectural fees is the correct answer. But let's just make sure the others are not. Grading of land. That's obviously a land expense. Cost of hauling material from the demolished structure. That would also be a land expense. So yes, architectural fees, by definition, is our building cost that would be capitalized. What certain kinds of assets are built that require public welfare and safety expenditures? Um, okay. So, um, this is definitional. Let me just give you an example of this. It's even a little bit. It's actually pretty top. It's quite topical. This issue. Think of like Red Hill Fuel, right? Um, After they're shut down, there's going to be certain expenses that are required for the public welfare and safety expenditures. So what would that mean? When they were being built, I don't even know when they. I think they were built after World War II. I think, um, which means that when they were built, um, you should have already booked the liability right then. Because the idea would be is that at some point in the future, this asset will be depleted and disposed of, and that expenditure would occur. So that would be our liability. And the others are just either don't make any sense or are just incorrect. Which of the following is not a difference between GAAP and international financial reporting standards? Well, they both um, do use discounted cash flow. They both, um, to determine their value, they both include the cost to sell and take that out of the fair value. Right to reverse prior impairment losses when there's no change in the estimates used to measure loss. Yeah, that would be the same. Do differences gap may trigger an impairment loss that would not be? No, that's not true. Okay, so that's good. So what would be not a difference? Gap and IFRS, they would both have the impairment loss triggered by the exact same thing. It's really only going to come down to the subjectiveness of when that asset is created of the creators and of the auditors about what the future impairment loss might be. Okay. Deuce Company is purchasing a truck. Okay. Purchased a truck $50,000 on January 2nd, 20x1. Expected salvage value of $5,000 at end of its 5-year useful life. Man, that truck's being abused. And we're going to be looking at this from a double declining balance depreciation. Okay. So double declining balance. So let's see, 5 years. So 20x1, 20x2, 20x3, 20x4, 20x5. So we got our 5 years there. What we know is that if we were to um, uh, take this all the way to the end, we should have 45,000 at the end of that because we need to have a salvage value of 5,000. So double declining balance, that would be the cost of the asset times 2. Um, so in 20x1, sorry, I'm just reading this over here just to make sure I'm all good. Okay, so in so what we know from the double declining would be, and it just wants it for 20x2. I'm not sure why I'm going through this much detail here. So 45. Sorry, I'm just doing the math here in my head. 32, 39, 5. Okay. Sorry, I'm just again doing the math here in my head. So if we were doing the straight line method and we wanted to end up at 45, this is pretty easy, right? So we would just take $9,000 a year, and it'd be every year, and it'd be the same thing. And after 5 years, 9 times 5, 45,000. So that would be our straight line method, the method we've already looked at before. um, the depreciation rate, if we're looking at the double declining balance, that would be 2 times basically the cost of the asset times the depreciation rate itself. So in this case, uh, 20, 50,000 times 18, 20, 38, and 20. And then 12. And then Two. Then okay, just confirming. Yeah, 45. Okay. So, oh, thank God. This is a pretty tough one. In my opinion, it's a pretty tough one. So, with the um, double declining balance depreciation, really what we're seeing here is that most, as you can kind of see here, our depreciation expenses are kind of lumped up primarily in the beginning as opposed to straight line, which is just constant throughout. Okay. Which of the following is not true? Okay. Um, well, the only one that's not true is actually the most patently false one here, which is the very last one. It is there is evidence that the level of R&D expenses are relevant to investors. Everything else here um, um, could be true or is true, right? So the first one could be true that $1 in R&D leads to a $5 increase in market value. Yeah, that could be true. Analysts adjust estimates of unrecorded research and development expenses to adjust reported earnings and books values. Yeah. There's a causal relationship between R&D expenditures and future financial benefits. I sure hope so. Okay. Impairment loss. What is the impairment loss? Well, that's just going to be our different. This is again largely definitional. This is just going to be our difference between the carrying value of the asset, which is in the nature of the question, and the fair value. Okay. I hope that helps you understand Chapter 11 a little bit better. Um, Again, if there's one where I didn't give you enough detail on something and you have some follow up questions, just let me know. But I think my math is all correct, and I think we're pretty good here.